The expansion of the M2 money supply is not just a data point buried in an economic report. It's a transformative signal of how power is shifting in the global financial system. To understand its full implications, we must first grasp what M2 really represents and why its sudden explosion in recent years has become a driving force behind nearly every major asset movement we see in 2025. M2 includes not only the cash we hold in our hands and the balances in checking accounts, but also savings accounts, short-term deposits, and other easily convertible forms of money. In essence, it's the broadest and most accurate reflection of how much liquidity, or money that can be spent, exists in the economy. When M2 grows rapidly, it means more money is circulating, and that has profound consequences for everything from inflation to investment to inequality. Over the past few years, governments around the world have faced an impossible challenge: how to sustain growth and stability in a system burdened by massive debt, slowing productivity, and social unrest. Their solution, repeatedly, has been to print money. In the short term, this strategy seems to work. Markets rise, unemployment falls, and consumer confidence improves. But underneath that surface optimism, the fundamental value of money is being eroded. The more currency that enters circulation, the less each individual unit is worth. This is not theoretical, it's a law of economics. When the supply of money increases faster than the supply of goods and services, prices rise, and the purchasing power of that money falls. This is the core of what I call the silent tax inflation. It's not legislated or voted on, but it's one of the most powerful wealth redistribution mechanisms in existence. It punishes savers and rewards borrowers. Those who hold cash see their real wealth decline, while those who own productive or scarce assets see their nominal wealth rise. And this is why the M2 explosion is not just a statistic, it's a signal of who gains and who loses in the next phase of the economic cycle. To truly appreciate the scale of what's happening, we can look back through history. After World War II, governments inflated away massive wartime debts through controlled monetary expansion. In the 1970s, oil shocks and loose monetary policy led to runaway inflation, sending gold soaring and eroding trust in fiat currency. In 2008, central banks responded to a global financial collapse with quantitative easing, injecting trillions into the financial system. And during the 2020 pandemic, they doubled down, printing more money in 2 years than in the previous 2 decades combined. Now, in 2025, we're living in the aftermath of those policies, an era defined by abundant liquidity, but also by fragile trust in the system that created it. Every time a central bank prints money, it's effectively saying, we will create value today at the expense of tomorrow. The problem is that tomorrow eventually arrives. The debts must be serviced, confidence must be maintained, and the illusion of stability must be sustained. When M2 surges beyond the pace of real productivity growth, the economy begins to drift into distortion. Asset prices rise not because of innovation or efficiency, but because there's simply more money chasing the same investments. This is how we end up with bubbles in housing, in equities, in digital assets, all fueled by cheap and abundant money. But the expansion of M2 also reflects a deeper truth about our current financial order. It's built on credit, not cash. In modern economies, money is created not by printing presses, but by lending. When banks issue loans, they create new money. When governments run deficits and issue bonds, they create new claims on future money. This means that the M2 explosion is not only a reflection of government action, but also of collective behavior, the willingness of consumers, corporations, and investors to borrow and spend. It's a mirror of our collective psychology, driven by optimism, fear, and the expectation that central banks will always step in to prevent collapse. However, the danger of this mindset is complacency. When people believe money will always be available, risk-taking becomes reckless. The more liquidity that flows into the system, the harder it becomes to distinguish between genuine value creation and speculative excess. Markets start rising simply because they're rising. Momentum replaces fundamentals, and perception replaces reality. In this way, the M2 explosion can create a self-reinforcing loop. Higher liquidity leads to higher asset prices, which create a sense of wealth, which leads to more spending and borrowing, which further expands the money supply. Eventually, the system becomes addicted to liquidity. Now, let's connect this to the broader shifts we're witnessing in 2025. The global monetary base has grown at a pace that far outstrips productivity. Central banks, in their attempt to avoid recession and deflation, have entered what I call the liquidity trap of confidence. They can't easily reverse course because withdrawing liquidity would cause markets to fall, debt to become unmanageable, and political pressures to explode. But continuing the expansion only accelerates inflationary pressures and asset bubbles. It's a delicate balancing act with no easy exit. The result of this dynamic is a new financial paradigm, one where traditional measures of value are breaking down. Interest rates no longer accurately reflect risk, they reflect policy. Asset prices no longer reflect earnings potential, they reflect liquidity conditions. The M2 explosion has effectively shifted the economy from being productivity-driven to being liquidity-driven. And while this can fuel short-term growth and wealth creation, it also creates systemic fragility. The system becomes increasingly dependent on constant injections of money to stay stable. For investors, understanding this is critical. The question is not whether money supply expansion will continue. It will, because the alternative is collapse. The real question is how to position yourself within that reality. Cash, once considered safe, is now the riskiest asset because its value is guaranteed to decline over time. Real assets, equities in productive companies, and even digital stores of value like a Bitcoin have become the new forms of defense. But even these are not immune. They are all reflections of the same liquidity wave. When we analyze this period through a historical lens, we see that it fits perfectly into the long-term debt cycle described in Principles for Navigating Big Debt Crisis. As debt accumulates, central banks lower interest rates and inject liquidity to keep the system functioning. Over time, this leads to diminishing returns. More money creation is required to achieve the same economic result. Eventually, the money printing reaches a point where confidence begins to erode. That's where we stand today. The M2 money explosion is, therefore, both an opportunity and a warning. It's an opportunity because liquidity creates short-term booms, but it's a warning because unsustainable growth always ends with a correction. The wise investor doesn't fight the wave but understands how to ride it strategically, cautiously, and with an eye on the long-term fundamentals that still matter: productivity, innovation, and real value creation. So when you hear that M2 is expanding faster than ever, don't see it as just another economic headline. See it as a map of where capital will flow next, where risk will accumulate, and where opportunity will emerge. Money is not neutral, it's directional. And in 2025, its direction is clear away from stability toward volatility, away from cash, toward assets, away from trust in central authority, toward individual control. That's why understanding M2 is not merely an academic exercise. It's essential survival knowledge in the new financial era. The expansion of the money supply is rewriting the rules of wealth, power, and policy. The sooner you grasp its mechanics, the sooner you can protect yourself and perhaps even thrive. in the greatest monetary transformation of our time. Gold, stocks, and Bitcoin, three vastly different assets born from different eras, philosophies, and technologies, are now united by one powerful economic reality: the explosion of money supply and the silent devaluation of fiat currency. In 2025, this convergence isn't a coincidence. It's a reflection of how every generation, every class of investor, and every financial ideology is responding to the same problem: the declining trust in money itself. Each of these assets tells a story about where people are placing their faith in a world where printed currency buys less each year and central banks play an increasingly dominant role in determining the value of everything. Let's start with the simplest and oldest form of wealth: gold. For over 5,000 years, gold has been humanity's universal measure of value. Empires have risen and fallen, currencies have come and gone, but gold has remained constant, not because it's shiny, but because it's scarce, immutable, and beyond the reach of political manipulation. When governments expand the money supply, people instinctively return to gold because it represents trust without dependency. It doesn't require a promise to hold value. It is value. In today's context, as the M2 money supply has exploded to unprecedented levels, gold's role as a store of value has resurfaced with renewed importance. Investors, sovereign wealth funds, and even central banks themselves are accumulating gold as a hedge against monetary instability. This isn't speculative behavior, it's insurance. Gold doesn't pay interest or dividends, but it offers something more valuable in an age of money printing permanence. It's the one asset that doesn't rely on anyone's balance sheet. But gold's rise in 2025 is also symbolic. It represents a quiet rebellion against the modern financial system. As interest rates fluctuate and currencies lose credibility, gold becomes a mirror reflecting the erosion of trust. Its value rises not because of innovation or productivity, but because of fear. Fear that the financial architecture built on debt and printing presses is unsustainable. And that fear is rational. Every time governments dilute the value of money, all those orders, they indirectly strengthen the argument for holding something that can't be printed. Now let's shift to stocks, a very different kind of asset. Stocks represent ownership of productive capacity. While gold defends wealth, stocks create it, at least in theory. In a healthy economy, rising stock prices reflect innovation, growth, and expanding profits. But in the liquidity-driven era of 2025, the story is more complex. Stock markets around the world are booming not solely because companies are more productive, but because the ocean of liquidity unleashed by central banks has no other place to go. When interest rates are low and cash loses purchasing power, investors are forced up the risk curve, from savings accounts to bonds, from bonds to equities, and sometimes even beyond into speculative territory. This forced migration of capital is one of the defining features of this era. The stock market becomes a sponge absorbing excess liquidity. Corporations, aware of this dynamic, engage in massive share buybacks, further driving up valuations. Meanwhile, passive investing and algorithmic trading amplify the trend, pushing prices higher regardless of fundamentals. The result is an illusion of prosperity. A stock market that looks strong while the real economy lags behind. But even within this distortion lies a lesson. The best investors don't resist reality. They study it. They understand that liquidity cycles drive asset performance. In an environment of monetary expansion, equities in companies that can adapt, innovate, and pass on inflation costs become invaluable. Businesses tied to tangible productivity, energy, infrastructure, technology, commodities thrive, while those reliant purely on cheap debt eventually struggle. So while gold is the hedge against currency decay, Stocks are the mechanism for navigating it. They offer participation in the new wave of capital redistribution, from cash to assets, from savers to investors. Then comes Bitcoin, the newest player in the store of value game and arguably the most controversial. Bitcoin was born out of a crisis, the 2008 financial collapse, as a technological solution to a philosophical problem. What happens when people lose faith in money controlled by governments? Its answer was simple yet revolutionary. Create a decentralized currency with a fixed supply, one that no central authority can manipulate. For years, it was dismissed as speculative, unstable, or irrelevant. But in 2025, it stands as a core part of the global wealth conversation because it represents something no other asset can: programmable scarcity. Bitcoin is the digital mirror of gold, but with a key difference. It's accessible, borderless, and transparent. In a world where capital controls, inflation, and debt crisis plague nations, Bitcoin provides individuals with direct control over their wealth. It doesn't rely on banks, intermediaries, or governments. It's money governed by code, not politics. This is precisely why, during times of monetary excess, Bitcoin tends to boom alongside gold and stocks, not because they are correlated in value, but because they are correlated in purpose. All three are reactions to the same cause: the degradation of fiat trust. To understand this phenomenon, imagine the global economy as a reservoir. The M2 expansion pours water into it. That liquidity has to go somewhere, and it seeks the highest points of perceived safety or return. Some of it floods into gold for those seeking historical security. Some flows into stocks for those seeking growth and yield. And some rushes into Bitcoin for those seeking independence from the system altogether. Together, these three assets form the modern triangle of wealth, defense, and opportunity. But their simultaneous rise also signals something deeper: the beginning of a monetary identity crisis. When every form of value is rising in nominal terms, what does that say about the value of money itself? The answer is unsettling. It's not that assets are becoming more valuable. It's that money is becoming less valuable. That's why gold, stocks, and Bitcoin all appear to be booming. The common denominator isn't innovation, it's inflation. However, each of these assets comes with its own strengths and vulnerabilities. Gold is stable but unproductive. Stocks generate income but are vulnerable to earnings shocks and market corrections. Bitcoin offers autonomy but is volatile and still maturing as a global asset class. The wise investor in 2025 understands that no single asset can provide absolute security. True protection comes from balance, from understanding the role each plays in a world where traditional safe havens have become uncertain. What's happening now is more than a financial trend. It's a psychological shift. The public is waking up to the fact that governments can't print prosperity forever. As confidence erodes, people seek tangible or decentralized value. That's why millennials and Gen Z are drawn to Bitcoin. They see it as digital gold, untouchable by policy or inflation. Meanwhile, older generations and institutions continue to rely on physical gold and equities. The generational divide in investment preferences is not a difference in logic, but a difference in trust in systems versus trust in technology. Ultimately, the simultaneous rise of gold, stocks, and Bitcoin in 2025 is the visible symptom of the same underlying disease: the overproduction of money. Each represents a different cure, a hedge, a growth engine, and an escape. Together, they are the new global language of wealth preservation. And yet, there's an irony here. The very forces pushing these assets higher, inflation, debt, and liquidity, are also the forces that could destabilize them if confidence collapses entirely. If inflation spirals, if policy fails, or if liquidity dries up, even these assets will face turbulence. But those who understand their underlying purpose will remain anchored. They will know that while prices may fluctuate, the principle remains constant in a world of unlimited money. Only scarce assets hold meaning. So, as gold glitters, stocks climb, and Bitcoin breaks barriers, remember that none of these movements are random. They are the market's way of expressing one profound truth. People are searching for safety in a system where money itself no longer feels safe. The question for every investor in 2025 isn't which asset will rise next, but rather, what do you truly trust when trust in currency is gone? Every major financial era in history has followed a rhythm, a cycle that begins with optimism, grows into excess, and ends with correction. This rhythm is not random. It's driven by the forces of debt, credit expansion, and monetary policy. In 2025, as we witness markets soaring and liquidity flooding every corner of the global economy, it's essential to understand that this isn't new. It's part of an age-old pattern that repeats itself again and again because human behavior, the driver behind markets, rarely changes. At the heart of every boom and bust lies one common element of debt. Debt is both the engine of growth and the seed of crisis. When used wisely, it fuels innovation, builds infrastructure, and expands productivity. But when it grows faster than income, it creates fragility. Eventually, the system becomes dependent on constant credit expansion just to survive. That's where we are today, in a global economy where credit has replaced real growth and where central banks are the primary drivers of stability. Throughout history, the story has played out in remarkably similar ways. During periods of expansion, credit is cheap, optimism is high, and people borrow more. Governments, corporations, and consumers all join in, creating an illusion of prosperity. Asset prices rise, confidence grows, and debt becomes normalized. But as the cycle matures, the amount of new debt needed to generate each additional unit of growth increases. The system becomes saturated, and when that happens, something has to give. Either growth slows or defaults begin. To prevent that, central banks step in using their most powerful tool, liquidity. This intervention usually starts with good intentions. Policymakers lower interest rates to stimulate demand and investment. When that isn't enough, they inject money directly into the system through quantitative easing, buying bonds, mortgages, and sometimes even equities. The goal is to prevent deflation and maintain confidence. But over time, this artificial support distorts market signals. Prices no longer reflect productivity or true value, they reflect the abundance of money. This is what we call a liquidity-driven market, one in which central bank policies, not fundamentals, determine the direction of asset prices. In this stage of the cycle, we see three parallel effects. First, inequality rises. Those who own assets, stocks, real estate, commodities, digital currencies, see their wealth multiply, while those who depend on wages fall behind because their incomes can't keep pace with asset inflation. Second, risk perception collapses. Investors begin to believe that central banks will always intervene, that markets will always recover, and that downturns are temporary. And third, innovation begins to shift from the real economy to financial engineering. Companies and investors focus more on manipulating capital than creating value. This combination is incredibly powerful